You should not start a business if all you want to do is get rich and make a lot of money. I'll show you what I mean, and I'll show you what you should do instead if that's what you want. If you just want to make a lot of money, you're going to want to do something and see a return. You're going to want to take an action and make money. Versus when you're starting to start a business, now you're going to have to do things that give you zero return. And sometimes you're going to have to do things that give you a negative return. And when your mindset is so focused on just making a lot of money, you're not going to have the passion, the drive, or the work ethic to do the things that don't give you the return, which is what it takes to build a business because of something called resource allocation. When Elon Musk sold PayPal, he made $180 million. He was rich by any measure possible, and he could have never had to work another day in his life. But that's not what he did. He took the $180 million and he reinvested all of it. He took $100 million and he put it back into SpaceX. He took $70 million and he put it into Tesla. And then he took $10 million and then he put it into Solar City. Then, not too long later, he realized he left no money left over for himself and he had to borrow money from his friends to pay rent. Resource allocation is when you take the business that your business is making and then you shove it back into the business. That way your business can grow bigger instead of you taking that money and going out and buying a bigger car. See, Elon Musk could have easily said, I'm done. I'm rich. I got $180 million. I could just throw this money into a couple of real estate properties. I'll never have to work for my money again. But that's not what he did. And the kicker is he would have never got that $180 million if that was his mindset in the first place, just to make a lot of money. So now let's think about this. Let's assume now that you can go out and you build a business that's making $1 million a year in revenue. Your numbers might look like this. You make $1 million a year in revenue. Your operational costs are $220,000 a year. Your labor costs are $280,000 a year. And then you pay yourself a small little salary of $100,000 a year. Oh, baby. Your profit is $400,000 a year, which means your business is making $400,000 and you're making $100,000. So now you're pretty rich. But now what do you do at this point? Because if you're wanting to be rich, well, now you can just take that $400,000 and buy a big home, buy a nice car, go on some nice vacations, and continue living your life. But the problem is, if you really want to build a business, you are never going to build a real business with that mindset. Because what's going to happen is, number one, if you start just living your life, well, now you're sucking cash out of your business so you can live your life. And now your time is going to be sacrificed because you're on boats, you're on planes, you're just having a lot of fun, and now you're not leading the business the way that you were before. And then the second thing is you're sucking the lifeblood out of your business. Your cash flow is the lifeblood of your business. That's what fuels your business. And so now when you take that $400,000, especially when you're in the early stage, you just made $1 million and you might think you're on the top of the world, but in the business game, that's nothing. You just made that $400,000 and now you start living your own life. Well, you're killing your business's life by doing that. If you really want to build a business, you know what you got to do? You got to take that $400,000 and throw it back into the business. Now you take that $400,000 and maybe you invest it in more advertising to get more customers. Maybe you invest it into a new department. That way you can grow your business. Maybe you invest it into better operations or better technologies. That way you can grow your profit margins. Because right now, when you're in the small stage of trying to grow, you have to stay aggressive of taking your cash flow, taking the lifeblood and injecting it back into the business. Because if you don't, somebody else is going to see your business and they're going to say, oh, this business is taking it kind of easy. How about I were to take their market share because they're not really working that hard. And so now you went from being rich to then being broke again because you didn't have the mindset of actually building a business. Building a business is a full-time job. I don't care how many people on the internet sell you this idea that you can just build this laptop business and never have to work a day in your life. The person getting rich selling you this is the person selling you that program. Now, there's a difference between a lifestyle business and a real business. You can build a lifestyle business if that's what you want. This is what's quote unquote the laptop lifestyle, where you are a blogger, you are just an influencer, you're a YouTuber, you're a content creator, and you make content when you want. Maybe you work a few days a week, and if you can build a big enough audience, then sure, you can live a comfortable lifestyle doing that, but you're not building a real business. You got to understand there's a difference between having this lifestyle brand and building a real business. Those are two completely different things. If you are an entrepreneur and you want to build a real business, it's going to take way more than the drive to want to make money. It's going to take way more than just passion. It's going to take hard work. It's going to take grit. It's going to take the ability to get punched in the throat. It's going to take risk. And then it's going to take the smart resource allocation, which means you're taking the money that your business makes business and you got to throw it back into the business when you make the money. I mean, you got to really think about this. If you look at some of the richest and wealthiest people in the world, Warren Buffett is in his 90s, yet he still goes to work every single day. He's one of the richest people in the world. He could spend $1 million a day and never have to work again, and not even have to ever worry about money again. Even his family would never have to worry about money again. But he doesn't do that. Instead, he goes to work every single day. Why is he going to work? He doesn't need the money. He doesn't need the paycheck. He doesn't need another $1 billion. It doesn't make any difference to him. He's doing it because it's the passion that he has. That's the value and the legacy that he wants to leave. That's what he loves to do. He doesn't just do it for the money. Obviously, money is a byproduct of what he does. He does it because that's something he wants to do. Mark Zuckerberg is the same thing. You can hate or love Mark Zuckerberg. The reality is he's rich. He could also spend $1 million a day, and he's pretty young. He could spend $1 million a day for the rest of his life, and he will never have to worry about money, and his kids will never have to worry about money. But he doesn't. He still goes into work. Why? Because he has a mission, he has a purpose, he has a value, he has a reason for doing what he does. And this is where, if your sole goal is just to make money, your sole goal is just to get rich, you should not start a business, because building a business is more than just about making money. Yes, some of the richest people in the world are entrepreneurs. These are people who built businesses. You can get extremely rich by building a business, but you're not going to be able to build a business when your sole motivation is, I just want to get rich. You got to have the value, the passion, the purpose, the drive, the commitment if you want to be able to build a successful business. And this goes back to the resource allocation. And I see this happen. Well, the first stage is people want to start a business because they want to get rich, and then you realize that it's really hard to start a business. So this is what weeds out that first flow of people, because now you want to start a business. You hear about all these people on the internet talking about how building a business is great because you can make a lot of money and you have a freedom and you no longer have a boss. And then you realize, oh crap, my customers are now the boss. And oh crap, if I'm not the boss of me, then this business is not going to go anywhere. And oh crap, I quit my job so I could build this business so I'd have more free time. But now in my business, I'm working 3 times more hours than I was at my job. And I was already working 50 hours a week at my job. Building a business takes a lot of time. You don't get paid time off when you're starting off. You don't get holidays. You don't have somebody paying for your health care. You don't have somebody paying for your benefits. You don't have somebody funding your 401k. You now have to create and build the whole thing. And all that risk is on you. So when things go wrong, it comes back to you. When somebody gets upset, it comes back to you. When customers are not happy, it comes back to you. It doesn't matter if you're not involved in the sales side. If customers are not happy, well, now you as the owner of the business are the one that has to deal with it. Even if it's an HR thing and you're not an HR person, if people in your company are not happy, it comes back to you. So now when you're building the business, everything comes back to you. And that's the first step, where you got to realize when you're getting involved in building a business, there's a lot of work involved. Now, some people will get past that stage because they have a real drive to want to make money. Then you start to grow and you'll start to make some money. And then the next thing that happens is you start to make some money, and now you have to face that question. I made $1 million in revenue. The company has a few $100,000 in profits. Now, should I go out and buy a Lamborghini, or should I take the money and put it back in the business? And this is a tough question, because now if you're 28 years old, you got a few $100,000 in the bank, your business is doing well. Well, now, it's time to show it off, right? I mean, you got hundreds of thousands of dollars in the bank. You're in your 20s, maybe you're in your 30s, maybe you're in your 40s. It doesn't really matter. But it's kind of fun if you're in your 20s, so we'll talk about that. If you're 28 years old and you have a few $100,000 in the bank, your business is doing well, you got to show it off with a Lamborghini, because everybody on Instagram who's an entrepreneur has a Lamborghini nowadays, or a private jet. So why not take the few $100,000 and go out and buy yourself a brand new supercar? But again, now resource allocation. You got $300,000 in the bank. That $300,000 could hire you a few employees who can help you grow the business to $1.4 million next year, maybe $3 million next year, maybe $30 million next year, depending on what the team does. That $300,000 you have in the bank could help you run some new advertisements to grow your sales for next year. The $300,000 could help you revamp all of your branding to increase how the user experiences on your website or your app. The $300,000 could help you buy new softwares, invest in new technologies, build new products to help increase your revenue. And this is where you got to keep your foot on the gas pedal if you're really trying to build a business, especially in the early stages, because now you got to stay aggressive to actually wanting to build a business, because as soon as you start pulling the cash out, you're pulling the blood out of the company. You're sucking the blood out before the company had a chance to really even thrive. And now again, it goes back to, did you want to build a business or did you just want to make some money? Now, if your goal is to build a business, you're going to have to go through that process, and then you're going to have to find the right balance for you, which is, when do you start taking your foot off the gas pedal? When do you start enjoying some of that money for yourself? When do you start working a little bit less? And everybody's going to have their own goals and their own kind of agenda as to when it's okay to pull their foot off of the gas pedal, and you're going to have to find the right balance for you. If you're kind of like, I want to be an entrepreneur, but I don't want to work for somebody else, but I also don't want to grind like that to build a business. Well, nowadays, with the opportunity to build these types of lifestyle brands, this has opened up more than ever. Lifestyle businesses are not bad. I mean, they're a way for somebody to make 6 figures, 7 figures a year by doing something kind of on the side. Now, it's not easy, and you're going to have to put in a lot of work to get there. But if you can build an audience, say you can build a YouTube channel with a few 100,000 subscribers, well, guess what? If you make a few videos a week and you have a few 100,000 subscribers and you can get some good sponsors and you have some decent views, yeah, you can make a good living. You can work a few days a week, travel, and work on your own schedule and not really have to worry about money too much. Sure, maybe you're not driving the Lamborghini, maybe you're not flying in private jets, but you're living very comfortable, which is fine for some people. But again, it's figuring out what you want. But if your goal is just, I want to make some money, I don't want to build a business, I don't want to have to deal with all the stress, I don't want to deal with all the headache, I don't want to have to deal with all the heartache, I don't want to have to keep reinvesting my money, I don't want to take on all that risk, I don't want to have to do all that crap that comes with building a business, then what's the other option? Well, in this instance, you got to figure out, how can you be in a position where you can make unlimited income and get a return for the work that you put in? Because when you're building a business, you're going to do a lot of things that might not give you a return. In fact, you're going to do things that will give you a negative return. But if you can be, say, a commissioned salesperson in the financial services industry, now you get rewarded every time you close a sale. Now, if you are a salesperson in the mortgage business, a salesperson in the insurance business, you have the potential to make a lot of money. The financial services industry has big margins, period. Mortgages, insurance, all of that stuff, selling the financial stuff, selling stocks, selling all those things have big margins. And you have the potential to make a lot of money pretty quickly. And now you don't have to worry about building a business. You don't have to worry about all that crap. Now, if your focus is just making money, learn how to sell, work in the financial services industry, and sell the crap out of whatever it is that you're doing, making money. And now you want to be smart with that money. Take it, invest it into your assets, real estate, stocks, whatever it might be, build your wealth, and now don't have to worry about money anymore. But this is where understanding there's a difference between making money as a salesperson, and there's a difference between building a business, and there's a difference between being a lifestyle brand. And you got to figure out which one's right for you. Now, none of these are bad. You just got to figure out what's the right strategy for you, because building a business has been glorified a lot with things like Shark Tank, with things like the internet, and people love selling the idea of passive income from building a business, which is kind of a really weird concept. You don't get passive income from building a business. Those are two completely opposite things, and now you have to understand the concept of negative returns. In fact, sometimes doing things that do not scale, right? We talk about building a business that's scalable. I've talked about that many times, where you want to build something that can grow, that doesn't necessarily need you. That's the definition of scalability, that it can grow and it doesn't necessarily need you to grow. But if you want that business to be able to grow and not need you to grow, you have to do things that can't grow. The CEO of Airbnb and the founder of Airbnb talks about this very openly, where the thing that allowed Airbnb to grow to where it is today was doing things that are not scalable. See, now when you talk about giving somebody a review, you can give somebody a 1-star review, it was complete crap. You can give somebody a 3-star review, it was average. Or you can give somebody a 5-star review, which is, it was an amazing opportunity, a amazing purchase, great thing. And what the CEO of Airbnb talks about is an 11-star review process, where in his mind, especially in the early stages, he wanted to create the opportunity for customers to be so blown away by his product, doing things that are unscalable, that way his early customers would fall in love with his company and his product. That way, in the future, the unscalable things will allow the company to scale. Let me show you his 11-star chart. Hypothetically, a 1-star in Airbnb would mean that you got to your Airbnb, nobody is there, you knock on the door and nobody opens. Now you're very upset and angry because it seems like a scam. A 3-star review would mean you get to the Airbnb, they didn't open the door at first, you had to wait 20 minutes, and then they finally let you in. You're a little bit upset, but you got the Airbnb, so it's okay. A 5-star review is you knock on the door, they open the door, the host lets you in, and everything is running just smoothly as you would expect. Things went just fine, but you're not going to go and rave to your friends about how amazing Airbnb was. You might just say the Airbnb was fine. A 6-star review in this instance would be you knock on the door, the host says, "Hey, I'm Reed, welcome to my house." And then they would show you around the house. On the table, there would be a welcome gift for you, a bottle of wine, maybe some candy. You open the fridge, there's some water. You go to the bathroom, there's toiletries there. They have just a bunch of things that you did not expect. They went above and beyond. That is a 6-star review, and now you're going to be much more likely to go out and tell your friends about it. A 7-star review is you'd go knock on the door, Reid Hoffman opens it, you get in and they say, "Welcome, here's my full kitchen. I know you like surfing. Here's a surfboard waiting for you. I book lessons for you. It's going to be an amazing experience. By the way, here's my car. You can use my car. There's this amazing restaurant in the city of San Francisco. You got a table there." And now you're like, whoa, that's way beyond what you expected. 7 stars. A 10-star review would be as soon as you get off the plane, there's 5,000 high school kids cheering your name with cards welcoming you to the country. You get to the front yard of your house and there's a press conference there for you, and it would just be a complete mind-blowing experience. And then of course, an even more over-the-top 11-star review would be you go to the airport and there's Elon Musk waiting for you saying, "We're going to space." That chart, by the way, is from a book called Masters of Scale. If you have not read that book, I recommend every entrepreneur go out and read that book. Now, what does this mean? Well, options number 10-star and 11-star are clearly a little bit too crazy and too expensive. You're never going to be able to ever make any money doing that. But what the CEO of Airbnb says is this is a good mental exercise to really play out what does an amazing experience look like and what does a completely over-the-top experience look like, and how can you create experiences, especially in the early days, which give your customers a 6-star, a 7-star, maybe an 8-star review. That way now your early customers are blown away by what you do. They go out and they tell all of their friends, they tell all their coworkers, they tell all of their family about the amazing experience they had with Airbnb, because that's what's going to allow you to build your loyal customers early on. Now, what does that mean? Well, financially, that means you might be losing money on some of these unscalable things because you're doing things that are not scaling. You can't go and keep spending money on every single customer and never make any money, but in the early stages, you want to make sure that your early customers are loving your product. You might have to spend more time talking to each one of your early customers to see what they like, what they don't like. Your time isn't scalable to do that. And when you're so focused on just making money, why in the world would you want to go out and spend money on something that's not going to give you a return? You already got the customer. Why go out and keep spending more money on them? Because if you want to build a business, you need to have that love. You need to have that trust. You have to go above and beyond to build that brand presence. That way other companies can't compete against you. Because when other companies are in it just for the money, well, they're going to not do the things that you do because you're willing to do things that don't scale. And sometimes when you want to build a scalable business, you got to do things that are not scalable. And that's the difference between building a business and just trying to make money and a lifestyle brand. And this is where now you got to figure out where along this trajectory do you want to be. You can work to build a business, but again, you got to have that entrepreneurial spirit where the purpose here is to build that value, to build that product, to change the world, to create something that is going to leave a legacy on the world. That is what an entrepreneur does. If you want to build a business, you have to have that mindset. Then you have the lifestyle brands, which is I want to build a business that's going to fund my lifestyle and where I don't have to work too hard, where I just can kind of fund a decent lifestyle. I can have some nice things. Maybe I won't become super rich, but I'll have some nice things and hopefully I can have a decent lifestyle. In order to get there, you're going to have to put in a lot of work. But once you get there, then you can kind of coast and you know that you're never really going to be able to scale, and you have to accept that for yourself. Now, again, there's a lot of ways that you can do this. It doesn't just have to be a content creator. There's a lot of brands out there that are lifestyle businesses. A lot of mom and pop businesses are a kind of lifestyle businesses, but unfortunately, a lot of the mom and pop businesses are really not good lifestyle businesses because, well, if you go see what convenience stores owners or gas station owners, the lifestyle that a lot of them live, well, now you're working 7 days a week trying to run this lifestyle business. And so you got to understand now, when it's a lifestyle business, sometimes a lifestyle isn't so glamorous. Now, if you get on the internet and you can build a big enough audience, sure, the lifestyle can be a lot better, but you got to understand the scalability that comes with that. And lifestyle businesses have their own kind of range of what work looks like the Kim Kardashian lifestyle business is 24 hours a day, 7 days a week, no holidays, because if she goes out of the house, someone's taking pictures of her, versus somebody who has 400,000 subscribers on YouTube. Well, you have a lot more flexibility and a lot more freedom, but you're also not going to make as much money as Kim Kardashian. Then you got the hustler who's just trying to make money. You can make a lot of money as a commission salesperson, especially if you're working in the financial services industry. But understand that you're not building a business. You're not getting any equity in the company. You're just getting a big paycheck. And this is where I do want to caution you that if this is something you want to do, fine. But don't get caught up into that commission salesperson lifestyle, which is you start making money and you start living bigger. You make more money, you drive a faster car. You make more money, you have a bigger home. I've seen this happen because I work with a lot of salespeople. I am a licensed real estate salesperson. I've worked with a lot of realtors. I've worked with a lot of mortgage brokers. I've worked with a lot of insurance salespeople, people who make great money. It's also cyclical. You're going to see booms and you're going to see busts. You're going to see booms in the housing market. You're going to see busts in the mortgage market. You're going to see booms in the insurance market. You're going to see busts in the insurance markets. And that's where use your money smartly. You can make a ton of money, but please put that money into assets. That way you can actually sustain and keep that wealth instead of doing what everybody else in that salesperson business, which is you live based off of what's happening in the economy. When the economy is booming, you're living big. When the economy is shrinking, well, so is your lifestyle. And this is where a little bit of smart financial planning can really go a long way. Now, going back to building a business. If you want to build a business, you're going to have to go through a lot of unrecognized crap. That's the reality of building a business. It has been glamorized a lot, but there's a lot of unrecognized crap where you're going to have to do things that don't necessarily make sense, and you're going to have to go through a lot of that crap in order to actually build that scale. And this is where it's going to be different for every industry, and you're going to have to find the right way to keep getting the reps in, to get your business heard, to get your business seen, to get the sales, and to grow. Like when I was trying to get exposure from Market Briefs and Briefs Media, which is my financial newsletter company, I initially started off by doing as many interviews as possible. Obviously, I talked about Market Briefs a lot here on my YouTube channel. Market Briefs is a free newsletter for investors where every day my team is breaking down what's happening in things like the housing market, the stock market, the economy, the global economy, and the crypto market. It's completely free, and you can read the newsletter in less than 5 minutes every morning. By the way, if you haven't joined yet, you can go to briefs.co/market. That's briefs.co/market. And I also got the link for you down in the description below. But I would mention it a lot here on my channel. And that was when I had the idea, well, if I can mention it on my channel, how can I get my market briefs heard on other people's channels? And so that was when I started doing a lot of podcasts and a lot of interviews and collaborations with YouTubers. Now, I started working with whoever would accept me. If a YouTuber had 20,000 subscribers, I was doing the channel. I was doing the interview. If a YouTuber had 5,000 subscribers, I was still doing the interviews. And so now I went for a long period because I didn't have a lot of experience doing these types of collaborations, talking on other people's channels, doing these types of interviews, where I was just doing pretty much whatever interview that I could get. And sometimes we would get like 7 new subscribers from the interview. And these interviews sometimes would take 30 minutes, 60 minutes, 90 minutes, plus the prep time and everything in between for me to go out, instead of working on building my own channel, instead of going out and working to build a company, for me to go out and get exposure onto somebody else's brand. And sometimes we would see 7 new subscribers come in from all that time, effort, and work put in, not to mention the time trying to secure and get the interview and pay for people to get these types of interviews. But I did that, and eventually I started to get seen by some of the bigger podcasters. And then I got seen by like the Lewis Howes, the School of Greatness podcast. That interview did really well, which helped me get onto Tom Bilyeu's Impact Theory podcast. That interview did really well, and that helped get me onto Jay Shetty's podcast. And in each one of these, I got more exposure for market briefs because then I would go there, I would talk about financial education, I would talk about things that are important to me, and at some point in the interview, we would talk about market briefs, which helped give more exposure to market briefs and briefs media. So yeah, I had to put in a lot of reps and a lot of time trying to do things that didn't scale, but that allowed me to get more exposure later on. And so this is where now you got to find where can you do the things. If you want to build a business, what can help you grow? If it is doing XYZ, if it's getting podcasts, you can't just go out and expect to get the big time podcast unless you can show that you can succeed on the smaller time podcasts. If you want to be a stand-up comedian, you're not going to end up at Comedy Central tomorrow. You got to show how you've done the work at the local stand-up comedy shows in your neighborhood, how you've done it in New York, how you've done it in LA, and then you can potentially get seen on Hollywood. Then maybe you get to be seen on Comedy Central. If you want to be an actor, it's the same thing. Get started on YouTube. Start putting out videos. Start creating sketches. The internet has made putting content out there so much more accessible. There's no reason why somebody who wants to be in the creative industry, an actor, a comic, a comedian, a film producer cannot start creating content and get seen. Before, you had to go out and actually get gigs to be seen. Now you can start just creating your own content. And yeah, you're going to have to put in the work. If you want to build a YouTube channel, guess what? In the beginning, nobody is going to see your stuff. In the beginning of my YouTube channel, I used to send out a mass text to all of my friends, hey, new videos out. And then my videos would have like 117 views. The first 100 views were just mine because I just clicked the refresh button 100 times. And then it would be my wife, who wasn't my wife back then, and maybe my brother, and maybe a couple other people. And that was really it. And then I kept doing that. But then eventually I went from 117 views to 217 views. The first 100 were me. The next 17 were my wife, my brother, and a few of my friends. And then there was a new 100 people that started watching my videos. And then it went from 217 to 500 views, and then 1,000 views. And that's how it slowly started to grow. Now my YouTube channel has been seen over 150 million times, which is really mind-boggling to think that back in the day, I had to refresh 100 times on each video. I did that every time because I hated the idea of having a video with less than 3 digits of views. Like 12 views just seems so embarrassing. So I hit the refresh button again and again and again and again and again until I hit that 100. True story. But this is where you got to start somewhere, and you got to put in that hustle, and you got to be seen. And this is whether you want to be known as yourself, as a creative, or whether you want your business to be seen. It's the exact same process because the name of the game is attention. You get customers because people heard about you, because people saw your brand, because people have seen your product. You can have the best product in the world, but if nobody knows about it, nobody's going to buy it. Your business needs that attention. It's the same with you. You could be the best comedian, the best actor, the best actress, the best educator out there, but if nobody's seen your content, nobody cares. This is where you need to now go out and get that attention for your business or for you or for your brand, whatever it might be. And that comes with the reps. And those reps are hard because most people get broke on the first 12 months of putting content out there, of doing things and constantly putting the work and not seeing any results. And that's a part of the game. My YouTube channel didn't really start getting any traction for the first 18 months. Now, 18 months, thinking about it in hindsight, doesn't seem like that long. Oh, a year and a half, that doesn't sound like that bad. Well, try going through that. Imagine putting out videos the first week, 3 times a week. And now you put out these 3 videos and you feel like, oh, I'm putting out the best videos ever. 3 videos in and you got 104 views on each video. And 100 of those are mine. Well, then you're like, well, let's see if next week is any better. Same thing. No additional views. Now you go the next week. Same thing. Nobody's watching your stuff. The next week, same thing. No one's watching your stuff. We're like, maybe I'll give it another month. Now, 4 or 5 more weeks go by. Still, nobody's watching. Then 6 months later, nobody's watching. And now people are like, dude, why are you still making videos? Why do you keep texting me about these videos and nobody's watching it? 9 months later, you keep texting your friends. Maybe you stop texting your friends. I'm pretty sure I stopped texting my friends like 3 or 4 months into it because they were all getting annoyed by my texts about new videos being out. 9 months into it, you keep doing the same thing. No one's watching. Maybe now 12 months and you're starting to see a little bit of traction, not much, but you're starting to see a little bit of traction and you're like, should I still keep spending all of my time doing this? And it goes back to now what's important to you. Are you doing something that can help your brand scale? Are you doing something that can help you scale? And you got to figure out what that thing is, because if you're just doing something that's not going to help you scale, that's not going to help you grow, that's not going to give you any upside potential, then maybe you should do something different. But if it has a lot of upside potential for you and it's something that you want to do and it's important for you or your brand, then you got to stick with it. And you got to keep putting out those reps, whether it's content, whether it's work, whether it's interviews, whether it's whatever. You got to keep getting the customers to see what it is that you have. And eventually, it might be another 2, 3, 4, 5, 6, 12, 18, 36, 48 months later, but eventually something will break. Listen to any great personal story, any great business. You got to put in the reps of doing a whole bunch of crap, getting nothing in return in order to be able to get to the point where you can get a disproportionate return for the little bit of work that you put out. And that's what building a business is about. There's a lot of similarities between building a YouTube channel and building a business. There's a lot of differences as well. But the similar part is you got to keep putting in the reps and not getting any results until you can start seeing results. And that is the difficult part, that if you're just in it to make the money, you're not going to be able to get through those reps. And even if you get through those reps, once you start making the money, then you're not going to want to do anything besides enjoy that money, which is going to then be the devastation of the business that you worked so hard to create in the first place. Now, that being said, I don't want people to misconstrue what I'm saying right now to say that, oh, Jaspreet is saying that you shouldn't worry about money or that money doesn't matter if you're an entrepreneur. If anybody tells you or tries to argue with you that money does not matter, I want you to show them this video, because I grew up being told my entire life that money does not matter. You should not worry about money. You shouldn't think about money. You shouldn't stress about money because money is taboo. Money is bad. Money is evil. Money makes people greedy. And at the same time, the people that were telling me this were my parents. At the same time, my parents were working their butt off to get paid. And it didn't make sense to me. You're telling me on one hand that money does not matter, that money is bad, money is evil, money makes people greedy, that money has all these bad qualities, and at the same time, you're working so hard to get paid. What's the disconnect here? And this is where you have to understand how money plays a part in our lives. Because you can put up the smoke screen and say money doesn't matter, money is evil, but then you have to go out and pay your bills, because your credit card company is not going to accept hugs, kisses, and love for a payment. And if they do, well, let me know. But they're not. And this is where you have to understand money is important, because money is what funds the food that you eat. Money is what pays for the roof over your head. Money is what pays for the car in your driveway. Money is what pays for your kids' college. It costs money to eat, and it costs money to feed other people. Most people have put out these taboos and smoke screens around money, and then they just say that, oh, somebody who has money is greedy. They must have done something bad. They must have done something shady. They must have done something evil, because we don't understand how they did it. And because we have so many insecurities about money, we just put up this smoke screen and never want to talk about it, when in reality, the first issue is we don't understand how money plays a part in our lives. You have to understand first that money is important, because money is what pays the bills. But there's a difference between being completely obsessed and greedy and money-centric in your life, and also understanding how money plays a part in your life, because those are two completely different things. When I grew up, I knew I wanted to become successful. I knew I wanted to become rich, not so I could have all these expensive things and so I could be this greedy, money-hungry person, but so I could buy my dad's time back. It was a different mindset, and that's where it just never made sense to me. Why are people putting up all these smoke screens around money and then working so hard to get the money? It doesn't make any sense. If you're stressing about money and saying that money doesn't matter, there's a disconnect there. And now, there is a disconnect, because you have to understand how money plays a part in your life. That way you can understand how to approach money. And when you understand this indirectly, it will help you understand and get more money as well. See, if you want to live a holistic and you want to live a fulfilled life, you have to be fulfilled in what I call the 4 fitnesses of life. I call this my quadrifit theory, where if you really want to live a fulfilled and happy life, you have to be fit in these 4 areas. First, you have to be physically fit. Second, you have to be mentally fit. Third, you have to be spiritually fit. And then fourth, at the top of this quadrifit triangle, you have to be financially fit. And the reason why I put it in this order, because this is how I felt in my life. This is how money played an impact. Number 1, you have to be physically fit, because, well, if you're on your deathbed, if you're so morbidly sick, it does not matter if you have $10 million. You just want to be healthy again. We've all heard the saying that a sick person has 1 wish and a healthy person could have 1,000 wishes. When you are sick, the only thing you want is to feel healthy again. You don't want to have millions of dollars. You just want to be able to breathe. You just want to be able to walk. You just want to be able to be healthy again. But when you're healthy physically, well, now you can go do whatever it is that you want and work to want to achieve that financial success. But then the second thing where you have to be fit is you have to be mentally fit. And I am so happy that mental health is finally becoming a topic that people are willing to talk about, because the reality is, if you have this demon in your mind, if you have this depression, you have this anxiety, the first thing is you have to understand that can be healed. But the only way you can heal it is if you first understand it, because a lot of times what happens is people have this depression or this anxiety or this feeling of just not being accepted. And then they assume that more money is going to fix this problem. More money can buy you a better therapist. More money can buy you better treatments, but it cannot fix what's in here. And this is where you have to address this. If you're in toxic relationships, you have to take care of those. If you're surrounded by people that don't care about you, that are constantly putting you down, you have to take care of that. You got to take your mind out of the toxic environment that you're in and put it into a healthier, more stable, more better environment to allow your mental health, your happiness to grow. You can be happy with $20,000 a year, and you can be happy with $2 million a year. The money will allow you to do more things that make you happy, but the happiness itself doesn't come from having a big bank account. It comes from living a fulfilled life, and that's the first step to being happy. And so this is where now you got to make sure mentally between these ears you are okay, because if you're miserable here, you're never going to be able to live a more fulfilled life when you have the money. More money is going to make you more depressed. Then the third step to being a completely fit person is being spiritually fit. And this does not necessarily mean religious. This means now having a purpose in life. What are you getting up for every single day? Take a look at Warren Buffett, Mark Zuckerberg. Why do these people still go to work? They have more money than anybody can imagine, yet they're still getting up, going to work every single day. It's because they find purpose in what they do. It's not just because they made their money that they can go out and do whatever they want. It's because they love what they do. That gives them fulfillment. Each one of us have a reason for wanting to be here. And there's a whole bunch of crap on the internet where people say, you got to find your purpose. Build a business around your purpose. Well, everyone's purpose changes every 6 months. I don't know what my purpose was 4 years ago, but it wasn't what I am doing now. And my purpose is probably going to be different 4 years from now. And this is where you got to understand, what is your purpose? I remember reading books about finding a purpose when I was getting started in my entrepreneurial career, and I was so confused because I had no idea what my purpose was. That's okay. Your purpose is going to change, but you have to have a reason for wanting to get up every single day, a reason for wanting to go out and do things, because if you don't, well, once you get money, now you're going to feel even emptier, because now you have no reason to get out of bed. You got to find that spiritual purpose. That way you can be okay with yourself with $2 million and $20,000, because then once you become financially fit, which is the top of this quadrifit triangle, more money will allow you to live a more fulfilled life financially. More money will mean you don't got to worry about paying the bills anymore. More money will mean you can take your spouse on the vacation that they've been wanting to go on. More money will mean, well, you can take your kids out to Disneyland, finally. More money will mean you can help fund your kids' college fund. More money will mean you can drive that nicer car that what you want. More money will mean you can buy the Rolex that you've been wanted. More money will mean you can do more things that make you happier. And this is where you have to understand how money plays a part in your life, because if you don't have money, because you have a lot of people out there that say, oh, you don't got to worry about money. Money's not that important. Well, guess what? If you don't have money, well, now you're going to be stressed about paying your bills. Well, what happens when you're stressed about paying your bills? Now you can't afford the good food anymore. That can affect your physical health. You can't afford the gym anymore. You can't afford a good trainer. You can't afford the nice things to take care of your physical health, and that could put that down in the dumps. If you don't have money and you're always stressed and you're always fighting with your spouse about money, because guess what? Money issues are one of the leading causes of divorce. Well, that could put a lot of strain on your mental health. More money can also help find you that ability to find a sense of purpose, because when you don't have money, you can very easily be lost and confused and not have any sense of direction in your life, because you're constantly just worried trying to figure out how do you pay your bills. So yes, there is money involved in each one of these things, but each one of these things are also independent in the sense that you have to work to be physically fit. You have to work to be mentally fit. You have to work to be spiritually fit. And you can do all of those things without having money. More money will just allow you to amplify the different points in your life. And this is where it is important now for everybody to go out and get their money, because the reality is money just amplifies who you are. If you give a good person money, they have a tool to do more good. If you give a bad person more money, they have a tool to do are bad. Money doesn't make you a good person, doesn't make you a bad person. It just amplifies who you are, which is why we need more good people with money. And guess what? It costs money to eat, and it costs money to feed other people. If you're saying, oh, but I just want to help other people, I want to give back, then go out and get your money. That way you can go out and feed other people. It is so silly to see people sitting there pointing fingers saying, oh, you should give to homeless people. Oh, you should help with the drug problem. Oh, you should do this. Well, how don't you get off of the sofa, pick your hands up off of your butt, stop playing Xbox, stop eating the Doritos and the Ho-Hos, and go out and make that change that you want. It's kind of funny because me and a few friends started a community service organization in Detroit, and we would do a lot of different types of events trying to give back to people in our Metro Detroit community. And every time we would do something, or not every time, but many times we would do something, we would get this interesting feedback from people that would never show up to our community service events. Sometimes we would go out and feed homeless people. And then we would get comments or messages from people saying, why are you feeding homeless people? That's just putting a Band-Aid on the problem. How about you go out and try to fix the drug problem? And then sometimes we would go out and we would provide hygiene kits to people. That way people who are homeless can have soap and have toothbrushes and have toothpaste and have socks. That way they can help clean up. And then you would hear things like, well, why aren't you feeding homeless people? They're hungry. What is a toothpaste going to do if they have nothing to eat? And then sometimes we'd go out and we'd buy pizza for homeless people. And then we get comments of saying, wait, is there pepperonis on that pizza? How dare you feed meat to people who are homeless? Because that's what they want. And so this is where you got to understand, people will always judge. People will always criticize no matter what you do, but you have to do what's right for you. And guess what? Your kids and your spouse cost money. It costs money to eat, and it costs money to feed other people. And when you got that money, you get to control what you do with that money. And the beautiful thing about this is everybody has their own passion. Somebody's going to be passionate about global warming. Well, if you got more money, you got more power, you got more control, you can do more things about that. Somebody's going to be passionate about cancer. When you have more money, you can raise more awareness and you can fund more cancer research. Somebody's going to be passionate about homelessness. Well, when you got more money, you can do more things about it and you'll have more power to create more awareness about it. Nobody can be passionate about everything. And this is a very hard lesson, that nobody's going to be as passionate as you are for the things that are important for you. No one's going to care about your business the way you do. And just like that, no one's going to care about your causes the way you do, which is why we need drivers for these causes. And the reality is, money is a powerful force, and that can drive people, and it gives you power automatically. So if you want to make a change in the world, well, you can get that money and help fuel the change yourself. Because if you're just complaining about other people not doing their part, go out and do your part first and inspire other people to follow you. Yeah, you can point fingers all day long, but until you can get somebody to get up off of their sofa and get their hands off their butt and stop playing Xbox, it doesn't really do any good. So instead of complaining about what other people are doing, this is where you got to take care of yourself, take care of your family, and work to take care of your community as well. Now, this brings me to the question of resource allocation for entrepreneurs. Because now, if your goal as an entrepreneur is to build your business, at what point now can you stop allocating all this money in your business back into this business? When can you start enjoying the money? And when can you start investing this money in other places? Entrepreneurs, if you are serious about building your business, then you need to be taking the money that you're making from your business and investing it back into your business, as opposed to taking that money and investing it in stocks and real estate, because none of those things are going to help build your business. But then the question is, when do you diversify? And when do you start taking some of this money and enjoying it for yourself? And the reality is, you're going to have to find where along the spectrum is right for you. Sam Walton, in his book, Made in America, the founder of Walmart, talks about this, which is very interesting. He says that when he was building Walmart, he wasn't investing his money into stocks. He wasn't investing his money in other places. He invested his money into one place. And the one place where he invested his money was Walmart. He didn't want to diversify. He put all of his eggs in one basket, which is his own company, which allowed him to grow his company. Now, did he take a risk? Absolutely. If Walmart went bankrupt, he would have lost everything. But that was what was important for him. Now, do you have to be as extreme as him? No, you don't have to build a multi-billion-dollar company, but you got to figure out where along the spectrum do you want to be. And this is where you have to figure out now, as you start to make money, when do you put it back into the business? When do you pull some money out? And when do you invest this money in other places like stocks and real estate? Because when you're building your business, there's no limit to the types of returns that you can see, right? When you put your money into the stock market, or when you put your money into the real estate market, you're generally trying to get a 7 to 10% return on your money. That is the average return on stocks and real estate over the last century. So when you take your money out of your business and now you put it into stocks or real estate, now you're getting a little bit of a return, hopefully. But when you take that money and you put it back into the business, now you're not trying to get a 7 to 10% return on your money. I mean, even late stage startups are still trying to grow by 20% or more. But if you're an early stage company that has a lot of room to grow, now you could be growing by 50%, 100%, 200%, maybe even 2,000% a year in the early stages because you take the money and you're investing it smartly back into your company. Now, there's also a risk here because when you take the money and put it back into your company, sometimes you're going to lose. When I was investing money into my blog because I wanted to build the Minority Mindset blog, I wanted to turn it into this self-funneling revenue stream where, okay, yeah, we can capture the Google searches and people search these financial terms on Google, that my blog will show up and then you're going to get all these amazing articles and that's going to generate me money. Well, guess what? I've probably put like $500,000 into that blog over the course of 18 months or so of hiring the smart people, hiring consultants and doing it. I wasn't putting my time into it, but I hired people to help take care of it and it was a complete flop. Sometimes you're going to lose money. All the $500,000 went down the drain and I'm never going to see that money again. Now, yeah, that sucked and that's a risk you take. But if you keep investing back into your company and you stay consistent with it, sometimes you're also going to make smart investments which will grow into something way bigger. And that's where now you have to find what's most important for you right now. Now, if you're looking for general rules of thumb, look, if your business is not making $500,000 a year, you should not be investing your money into stocks. You should not be investing your money into real estate. Right now, your money needs to be going back into the business to learn how to grow the business, to learn how to scale the business, to learn how to sell more products, to learn how to market, to learn how to get more customers. Because right now, in that stage, you have to get more money. Once you get to $1 million and more, now you have the potential to kind of figure out where and which direction do you want to go. Because now you can have the cash flow to, one, prove your concept. Once you're making $1 million a year, you can kind of prove that, okay, I have found something of value. And that's where then you can decide, do you want to continue building this business into something a whole lot bigger, or do you want to start taking your foot a little bit off of the gas pedal, take some of this money out for yourself and take some of this money out to invest it into other assets that we have some diversification. And now you can also start deciding, well, how much salary are you paying yourself? And now out of the salary, how much are you going to be investing as well? Like what I do here, I'll give you just my personal example. I'm not telling you what to do. I don't recommend what I do to anybody. I'm just going to tell you what I do. When I make money in my company, meaning when I generate money from my YouTube channel or from whatever I do, my speaking gigs, I don't take that money and just put it in my personal bank account. If I go out and I charge $20,000 for a speaking gig, that $20,000 goes into the business bank account and then I pay myself a salary out of that. I pay myself 20%. That is my commission. I pay myself, I'm on commission in my own company. I pay myself 20% of the revenue that I generate. So if I generate $20,000, that means I will pay myself $4,000. The other $16,000 stays in the business, which then goes back into the business to be reinvested. Now, when I get paid my salary, the majority of my salary is being passively invested. So I get my salary, I get a salary once a month, which is a commission off of the revenue that I get from like my YouTube ads and other things that I do. I take the salary. Now, most of this gets passively invested. Where does it get passively invested? It gets invested into places like the stock market. It gets passively invested into physical gold. Some of it gets passively invested into places like cryptocurrency. And then if I have a real estate opportunity, I will find money to do that as well, wherever that might be, because I also have my savings there as well. But the bulk of my money is being invested back into the business. Now, you might be thinking, but Jaspreet, then how do you go out and fund a big lifestyle? Well, I don't spend a lot of money. Most of the expenses that I have are write-offs. When I go and travel, these are for business purposes, meaning they come out of the business account. When I go out to eat, most of the times they're write-offs because I'm typically meeting with somebody and having a business dinner. Because guess what? A business dinner is a write-off. Me sitting by myself eating at a restaurant is not a write-off. So I want to make sure I have as many meals as possible with business people because that then becomes a tax deduction. I don't have an expensive car. I don't have expensive purchases. I don't have fancy watches. I don't have fancy clothes. So my personal expenses are very low. And yeah, I have business expenses, but that's where now I am really focused right now on building. Right? I'm working to build Briefs Media, which is my newsletter company. That's where my focus, my time, my energy, and my money is going. I do have my passive investments, and I kind of got started in a unique way where I started by investing. I started by working to buy rental properties. That was like the name of the game for me for a decade, where I learned about real estate investing pretty much on accident. And then I did whatever I could to make money to buy rental properties. I wasn't spending money on other things. I wasn't going out and blowing money on vacations. I wasn't going out and buying nice things. I was making money from all of my entrepreneurial ventures, whether it was event planning, whether it was wholesaling real estate, whether it was selling real estate as a licensed real estate salesperson, whether it was running my other businesses. I made money and I bought as many rental properties as possible to build a real estate rental portfolio, which also pays me with cash flow. And that cash flow is things that I will spend because this is passive cash flow, or generally passive cash flow. I still have to manage my portfolio and my managers, but generally passive. And then after doing that was when I really got more into business, learning about scalable businesses. So I kind of got into things a little bit backwards, but that was just what worked for me. So now my focus is building that active business. And this is where you have to figure out as an entrepreneur, what is the most important thing for you? Now, because I got involved with real estate early and because I got involved in investing in the financial education side early, I love the game of putting money to work. I love the game of investing. It's fun for me. So yeah, I still do that. I'm not actively buying stocks and real estate the way that I used to. Back in the day, it was, I made money, I'm going to go out and buy a rental property. I'm going to go out and look for an apartment complex. I'm going to go out and look for stocks to buy. That was where most of my time was going. Now, it's more of, if I see a great opportunity, I will go out and take it. But most of my time is being spent taking the money, putting it back into the business and working to grow the business. Is it risky? Absolutely. Briefs Media could go bankrupt. If it goes bankrupt, I will lose all the money that I put into the company. I will lose all the time that I put into it. And it would be a big, loss for me. But that's the risk that I'm willing to take. And now you as an entrepreneur got to find the right balance for you. There's no secret sauce to how you do this. There's no secret percentage of how you do this. Some people, Sam Walton went 100% into his company. I'm not there. You got to find where is the right percentage for you. Is it 20%, 50%, 70%? What is that right percentage? And at what point then are you okay pulling your foot off of the gas pedal? And that's where you got to figure out now, as an entrepreneur, when do you ease off of the gas and when are you comfortable? And if you can build a business big enough, well, you could also hire somebody else to take your spot if you feel like you don't have that same drive and commitment to keep taking it further. And that's where you got to figure out now, as an entrepreneur, as a CEO, as a person running the company, where it is that you want to be and how can you scale the business the way that's going to be best for you. If you are an employee in a company, you need to become a business owner as quick as possible if you live in the United States. Now, that being said, that does not mean that you should quit your job. That does not mean that you need to go out and start a business. That does not mean that you need to go out and operate a business. But in America, in this economic system, everybody needs to be a business owner because real wealth in America is built through owning things like businesses, not just by working in businesses. Now, you're probably hearing me saying this and you're thinking, what the heck, Jaspreet, are you talking about? None of that makes any sense. Well, think of it this way. When you go out and you work as an employee in a company, you are an expense to the company. Now, I'm not saying this as like, oh, you're bad for the company. No, what I mean is financially, you are an expense. If you don't believe me, look at any cash flow profit and loss statement for a company. Every profit and loss statement for a company will show you that this is the revenue on the top. This is where the money came in from. And then you'll see the expenses. And in the expenses, you will see a line item called labor. Labor is your salary cost for the company. If you're getting a salary out of the company, you are an expense to the company, period. Now you might be saying, but Jaspreet, employees are an asset to the company. Sure, you're right. They are. They're a vital part to growing the company. But financially, just on the numbers, we're not talking about emotions now, you are an expense. And so what you need to do is you got to take the money that you're making as an employee in the company and you need to put this to work. That way you can own some assets too. Now, the way that you do that is you take the money that you're earning and you take a piece of that and you're going to put that to work. Because guess what? Not everybody needs to be an entrepreneur. Not everybody should be an entrepreneur. Not everybody should try to operate a company. It's a lot of work and it's not for everybody and it's very overglorified. Owning and running a business is for people who have it in them and who want to do that. There's no shame in being an employee. And anybody who talks about being an employee as a bunch of crap is really a piece of crap. Anyways, There's nothing wrong with being an employee. So now what you need to do is take a piece of that money that you're making as an employee and put that to work. If you go out and take some of the money and you buy a share of a company on the stock market, you now become one of the owners of that company. If you go out and you buy one share of, say, Amazon, you become one of the owners of Amazon. Now, as one of the owners of Amazon, you don't get to tell Amazon what to do. You don't get to get involved in the day-to-day decisions, and you don't have to go out and start packaging boxes, but you get to share in the profits. The way you share in the profits is by, number one, if the stock price goes up because the company becomes more valuable, that means your stocks, your share becomes more valuable. Now, you don't actually make any money until you sell, just like how you don't actually lose any money until you sell. But if your stock goes up and you sell, that's how you make money, which is option number one. Option number two is some companies, not every company, but some companies will pay out what's called a dividend, which is a regular cash payment. They will literally just send you cash or deposit cash into your brokerage account every 3 months generally because you own a piece of this company. Now, not every company pays a dividend. The only companies that are going to pay dividends are companies that have big enough profits that they can afford just giving money to their shareholders. But that's another way that you can get paid. So now, if you are an employee, you don't own the company. You don't have any equity in the company. That's okay. But you need to be good at what you do. That way you can maintain that salary. That way you can maintain that income. And that way you can grow that income. It is your duty now to continue working there to be as good of an asset as possible, because the better asset that you are, the more your salary is going to grow. Yeah, that means you're a bigger expense. But they want to pay for that expense because just like every other expense in the company's profit and loss statement, they have these expenses to run and grow the company. So now, if you can build yourself up as a good asset, as you can grow the income that you can make, you have more money to go out and invest. Now, a simple rule of thumb, you can find the right one for you, is to follow something like a 75-15-10 plan, which says for every dollar that you earn, 75 cents is the maximum that you can spend, 15 cents is the minimum that you invest, and 10 cents is the minimum that you save. The reason why you want to do this is because now no matter how much money you're making, whether it's 25 grand a year or $2.5 million a year, you're always working to invest your money first. Now, where can you invest your money? I talked about how you can invest your money in stocks. You can also invest your money in places like real estate. You can also invest your money into other startups. There's a lot of places where you can invest your money. It doesn't really matter where you invest, but you want to be investing your money. Now, ideally, especially if you're just starting off, you want to invest your money into places that are a little bit more established, places like the stock market, places like real estate, and don't just throw your money around. I mean, you can if you start, but understand that investing is risky. You're never guaranteed to make money when you invest. And in fact, you will probably lose money at some point, but you got to get started. That way you can learn. But this is where now the key is putting your money to work and own the assets. If you don't own the company where you work at, you need to own somebody else's company, period. In this American economic system, that's how wealth is built. And the great thing about this system, if you understand it, because most people don't understand it, which is why they hate the whole system, but if you understand it, you can own a piece of the system without having to work to necessarily own each individual pieces of those systems. Once you have the money, you have the tools to buy a piece of that. Now, yes, that means you're going to have to work to spend less money. Maybe that means you have to work to earn more money, but you got to take some of the money that you're earning and put it to work to own a piece of the system. That way you can actually build wealth from the system, because if you don't, then you're just constantly going to be an expense in the system and never own any assets for yourself. That's where wealth is built. You already know you're working in a company. When you're working in that company, you're working to make the company more valuable. You're working to make your boss richer. That's a fact. But if you want to make yourself richer, you got to continue doing that, continue putting in the value, continue making that increase in your income. That way now you have more money to go out and own your own assets. That way you can own a piece of the pie as well. That's how wealth is built. And this is where you got to figure out what is the right way for you to do this. Now, this is where the financial education comes into play. Like when it comes to the stock market, you don't have to go out and try to find the perfect company unless that's something you're really interested in doing. You can just invest in a piece of America. There are funds, index funds, ETFs, Both of these things will allow you to own a piece of America without having to spend all that time, effort, and energy researching individual companies. Like there are funds on the stock market, index funds, and ETFs that will allow you to own a piece of the total stock market. There are funds that will allow you to own a piece of the S&P 500, the largest 500 companies on the stock market. There are funds that will allow you to own a piece of healthcare companies. There are funds that will allow you to own a piece of real estate companies. There are funds that will allow you to own a piece of companies that are focused on just paying dividends. This way now, if you don't want to be a professional investor, you don't want to have to research individual companies, you don't want to have to try to pick the best company, you don't have to worry about your portfolio, just find the right industry or fund that you want to invest in, which is significantly less work. And now every time you get paid, just take a piece of that money and start putting it into these funds. That's where wealth is built. Now, of course, you can get started with something like a 401k, something like an IRA. These are tax-deferred retirement accounts that make the process of starting investing very simple because lots of employers are going to offer these to their employees. They offer some tax benefits. There's some pros and cons to this, but that's just where you get started. You don't want to stop your investments just because you have a 401k or an IRA. That's just where you start. Get started with that because that's the most accessible, but then I want you to go even beyond that and continue investing yourself. Now, again, I want to remind you, investing has risks. You're never guaranteed to make money you invest. In fact, you will probably lose money at some point, and never blindly trust a random guy on YouTube, but understand that because you will have to lose money at some point because that's a part of investing. But the goal is to make way more than you lose. And the only way that you can do that is if you're willing to lose and you understand that that's a part of the process, because investing is a skill that can be learned. And patience is important. But you're never going to have that motivation to want to learn until you get some skin in the game, meaning until you put some of your own money into it and get started. And one of the most powerful assets, one of the most powerful tools, one of the most powerful values that will determine how wealthy you will become is time. The more time your money has to grow, the wealthier you will become, which means the sooner you start, the better, even if you don't have a ton of money. Listen, you don't need thousands of dollars to get started as an investor. You can get started with as little as $1 now. Thanks to the apps on the internet, you can start investing into these funds like I talked about with just $1. But you got to get started. The key is consistency. Don't just put in $1 and expect the $1 to turn you into a millionaire. You got to put in the $1 and then put in another dollar tomorrow, and then another dollar the day after that, and then start putting in money regularly, weekly. Then start putting in more money as soon as you start earning more money. The quickest way to start investing more money is next time you get a pay raise, don't inflate your lifestyle. Take that pay raise and take at least a piece of that, if not all of that, and put that money into your investments. You can't show it off the way you can a Rolex. You can't show it off the way you can a Gucci belt. But if you stay consistent with it, those investments will start to grow, and that's what's going to buy you the real financial freedom. It's not getting a big pay raise, because your pay raise is really fleeting, because if your company goes bankrupt or if your leg breaks and you can't go into work, that salary disappears. But your assets will still be there. Even if you can't go into work, even if you break your leg, even if your company goes bankrupt, your assets are still there. And that's where you want to have that strong portfolio of assets that you're working to build with your salary, because that's where wealth is built. This is where I think a lot of people ask that question of, well, should I be investing now? Because people are talking about a potential recession. Should I wait to invest? And are things going to get worse in the economy? Now, with the Federal Reserve Bank's latest pause on interest rate hikes, lots of people have questions as to what does this actually mean for the economy? Does this Fed pause now mean that our economy is set to boom, or are we going to see more economic pain ahead? Here's what Deutsche Bank had to say. The title of this article is Recession or No Recession: Why Deutsche Bank Says an Economic Downturn is 100% Inevitable. Notice what they said. They didn't say 90% inevitable, 99% inevitable. They said 100% inevitable. The reason why Deutsche Bank says that we're going to see more economic pain ahead is because of 5 risk factors that they point out in this article. Number 1 is the higher interest rates and the impacts of the higher interest rates. Number 2 is consumer spending and future slowdown in consumer spending. Number 3 is going to be a rise in future unemployment. Number 4 is slowing economic growth. And number 5, which is, of course, inflation. Starting with what Deutsche Bank said on interest rates. Obviously, we've seen interest rates rise from 0 to 5 and some percent over the last year and a half. And Deutsche Bank essentially says that, well, for one, there's going to be an impact of these higher interest rates that we have yet to feel. And then they went on to say this: the inflation that we see was induced largely by expansive fiscal and monetary policy, and the aggressive rate hikes needed to tame that have now materialized. Avoiding a hard landing would be historically unprecedented. Now, of course, we've heard the Federal Reserve Bank say that 1, a recession is not going to happen. 2, if we see a recession, it's going to be a soft landing. And then 3, now what we're hearing them say is a mild recession is now the base case. And what Deutsche Bank is essentially saying is, we have all this inflation because of the money printing. It's not because of greedy corporate profits. It's not because of other things. It's because we printed so much money. We threw this money into the economic system. All this money printing devalued our dollar. All this money caused so much demand from people to buy things. All this demand from people to buy things caused the prices of things to go up. And now we're trying to correct this problem. We have raised interest rates so aggressively over the last 18 months. We're still probably going to see another interest rate hike or 2. Deutsche Bank says we're going to see at least 1 more interest rate hike. And this rapid run-up in interest rates is going to have a consequence. Just look at history. They're saying historically, anytime you see interest rates rise this quickly in the past, you are going to have what they call a hard landing. And a hard landing essentially means you're going to see economic pain or some sort of recession. The second thing that Deutsche Bank talks about is consumer spending, and more particularly the future of consumer spending, because what Deutsche Bank says is that right now there's still a lot of excess money floating around out there from the COVID stimulus. Now, this is not just stimulus checks and unemployment checks, but all the money that was printed in 2020 and 2021, which was injected into the economy to businesses and other places, which is still floating around out there, which Deutsche Bank says still needs to be processed and put through the economy. Right? The reason why the prices of things can go up so much is because people still have the ability to pay the higher prices. Because if people can't afford to pay the higher prices of groceries, then groceries can't keep going up in price because, well, people won't be able to pay it. Just like that, it's the same with housing. If people can keep affording to pay the higher prices for homes, buyers will keep raising the prices of their homes. Just like that, when people can keep affording to pay the higher rent prices, landlords are going to keep raising the prices of their properties. This is the way that it has worked. And what Deutsche Bank says is that there's going to be an end to this coming soon, because all this excess money out there is going to hit a breaking point, and they're projecting that it's going to happen by the end of 2023, closer to October of 2023, where consumer spending is going to hit a breaking point where people are going to struggle then starting to pay for the higher prices. Now, of course, we still have the high inflation around. They talk about that in point number 5. But now when you mix the higher inflation with the reduced savings, the reduced credit ability, meaning people are going to be maxed out on their debt limits, well, that's going to create that slowdown in consumer spending, which will also hurt the economy. Now, we've done full deep dives of this on Market Briefs. Market Briefs is my free financial newsletter. If you have not joined Market Briefs yet, it's an easy and free way for you to stay up to date on what's happening in the economy, in the housing market, in the stock market, in the global economy, with a fun, witty, and easy to read email. You could read this email in less than 5 minutes every morning, and it's completely free. If you have not joined Market Briefs yet, you can go to briefs.co/market. That's briefs.co/market. And I also got the link for you down in the description below. The third factor that Deutsche Bank talks about is unemployment rates. And what they're saying is that unemployment rates are going to rise. They said that right now unemployment rates are around 3.7%. They're predicting that by the end of 2023, unemployment rates are going to rise to around 4%. And then in the first few months of next year, 2024, they're predicting 4.5% unemployment. So what are they saying? They're saying that now when the spending starts to decrease, that's going to mean that businesses make less money. When businesses make less money, that's going to cause more layoffs, more bankruptcies, which means unemployment is going to go up. And obviously, that's going to have an impact on the economy. The fourth factor that Deutsche Bank talks about is economic growth, and more particularly, the slowdown in economic growth. Now, obviously, we're already seeing the economy slow down in 2023. We're seeing the economy grow slower than expected, and they're saying that this is going to continue, and that in 2024, we're actually going to see an economic contraction. So our economy economy is not going to grow. It's going to shrink. And that's where we're going to see more pain, because now as the economy shrinks, that means people are going to have less ability to spend, especially now because of such higher prices. So you have less incomes because businesses have to do layoffs. And then at the same time, we have all these inflated prices, which then people with less incomes have to pay for these higher prices. And that's going to cause an even bigger correction in the economy. And then the fifth risk factor that Deutsche Bank talks about is the high inflation. Now, of course, we still have high inflation. CPI has fallen off of its highs, but it's still very high. Core inflation has fallen a little bit off of its highs, but it's still very high. Meaning inflation has fallen, but it's still there. Now, let me remind you, inflation, when it's coming down, does not mean that the prices of things are falling. It means that the prices of things just are not growing as fast. So over the last few years, we have all this built up inflation, meaning the prices of things have risen so quickly. And now the prices of things are still rising quickly, just not as fast as they were before. And the Federal Reserve Bank is working to slow down the price growth of things. Again, they don't want deflation. They're not asking for the price of things to fall. That's what they don't want. What they want is the prices of things to not rise as quickly. So you still have all this built up inflation, and it's still going to take more time for inflation to ultimately come down to 2%. Deutsche Bank talks about that. And then they say, well, this all ties together. Because in order to bring inflation down to this 2% target, the Fed is going to have to keep raising interest rates. And you can start to see now the higher interest rates cause more economic pain. It causes more layoffs, and it causes a slowdown in the economy. But that's what it's going to take to cool down inflation. And this is where Deutsche Bank is saying, a lot of people are saying, well, we're seeing this boom in the stock market, or we're seeing this happen or that happen, or unemployment is still low. Deutsche Bank is saying, well, look out the next 6, 12, 18, 24 months that is going to cause economic pain. The economic pain is still coming, and you need to be prepared for that. And this is where now your job as a financially smart person is not to be panicking about what's happening, but rather be aware of what the possible scenarios are. That way you're not blindsided by things, but rather you can capitalize on opportunities, because the reality is recessions create more millionaires than any other time. Why? Because recessions also mean that good assets can sell for a discounted price. But in order for you to buy these investments at a discount, you need, number one, the financial education to know what it is to buy. Because when most of the times asset prices fall, when most of the time stock markets fall, when most of the time real estate prices fall, people run away. They don't buy. So you need the financial education of know how to find a good investment, how to analyze it, and know what to buy. And then second, you got to be prepared. You need the money to actually be able to buy. Now, how do you do that? That means you got to prepare today. Like what I say is 2023 is not the year for you to go out and finance a new truck. 2023 is the year for you to get financially smart, which is now where you're working to spend less money, stop blowing all of your money, and work to earn more money. That way you have more money to invest. And even if you're not ready to invest right now, start building up this cash pile. That way, number one, you have savings to protect you against an emergency. And then number two, you have cash there ready to capitalize on investment opportunities that might come your way. And the only way you can capitalize on them is if you have the money to do that. And that means you got to get prepared now. Most people start preparing when it's way too late, but you want to prepare when times are okay. That way you can take advantage of opportunities when times are not okay. But that requires you to start building that financial education and getting prepared now. I sat down to do a podcast yesterday. It was called Habits and Hustle. And the host asked me point blank. She said, how the heck are people supposed to be able to do what you're saying? Invest and save, when right now we're living in a time where inflation is so high, people don't even have enough money to buy their eggs. How are they supposed to now live